Hello. In this video, I'm going to talk to you about getting ready for the financial negotiations that you will do with me. Um, think of me as the potential investor, both for equity and for debt, and that what you've got to do is provide me with information and an initial ask in terms of how much money you want and what you would have as your starting proposed rate. So that we can kick off the negotiations and I can come to some agreement with you on terms. So, what I'm going to show you now is basically the presentation that you should be putting together for me. So, generally, for the financial negotiations, you're going to want a business concept. You'll want a risk analysis, which includes your sensitivity and scenario analysis. We don't need the cash flows sort of period to period that will have already been covered in the preliminary pitch. And then you're going to need to talk about the financing assumptions in terms of debt equity mix and amounts and so forth that you have built into this. And then you're going to end with an opening ask. And at the end of that, then you and I will start going back and forth on what we think the right combination of amount to invest and share of the company and debt interest rate and so forth are. So, first, the business concept. Again, I'm not going to spend a lot of time here talking about this. It's the same one that we had in the preliminary pitch. If you have not looked at the preliminary pitch, just think in terms of that you probably need to state a need and how it is that your business idea addresses that need. That's kind of the key underlying theme here is that as an investor, I want to understand and get a sense for what it is that you're offering that isn't currently offered so that I can make my own subjective assessment about whether or not, in fact, that is a true need and that your assumptions make sense. I want you to offer up the risk analysis. And again, in this case, we've already done the sensitivity analyses, and so you just want to put these in here and talk about it. The kind of key thing from my standpoint, look, I'm giving it to you from my perspective as an investor, is that obviously I want to see the kinds of assumptions that are in there. I want to see the sensitivity to those, and I want to see the order of magnitude of how big of a shift we're talking about. And so, what we're really saying here as an example is it looks like the cost of equity. You're very sensitive to that, and that could swing your project quite a bit in terms of value. Number of days open, we can talk about that. But the bottom line is that you will want to say, this was done based on a particular cost of equity, somewhere around 15%. Days open, we just assumed 5 days a week, 20 days a month. So it's obviously sensitive to if we go more or less. Number of sales per customer, clearly sensitive to that. We assume $10. Food cost 25%, direct labor 25%. Students, we assumed it's sensitive to both of these. So at the end of the day, they're sort of the same variable reflected in two different ways. You can see that their impact is identical. So we assumed that 20% of the students that are on campus in a particular day would eat at our establishment at least once per day. And again, we're open enough for 3 meals a day, and so that's kind of the base. And the rest of these are relatively minor. They swing the overall value by less than $50,000 in terms of the value of the equity. So on NPV basis, you see the same sorts of factors are relevant. Cost of equity doesn't show up because we've got really cost of capital down here now. And we are sensitive to that, which embeds the cost of equity as well as the cost of debt. And so you can see that swings the value quite a bit, but basically the same sorts of factors. And so what we did was take that information and build a sensitivity or a scenario analysis, kind of a likely best and worst case. and we really focused in on the factors that we don't have 100% control on. Obviously, things like how many days we're open a week. We can make that a management decision on that. Similarly, if the financing assumptions are what we're here to negotiate, and so there's no point in doing some assumption related to that. And so we, again, base case, kind of our most likely scenario, we're targeting food and labor costs 25% each, about a $10 spend per customer on average, 20% per day of the students that are on campus. Again, if you want to think about that, that's on any given day, only about 50% of students are on campus. So throughout the week, what you're really talking about is that we might see, 20% of the students, or let's call it 10% of the students of the total population on any given day. In terms of that likely, we come out with an equity valuation of about $1.3 million, net present value about $2.4 million. If we go to a best scenario, sort of what we think is our best case, is that we might actually be able to achieve lower food and labor costs. Some of that will be because of scale, and some of that might just be because we're a little bit better able to manage the menu. Might get customers up to sort of an average $15 spend. Again, we don't really control that, but if you get the menu right and people stay and enjoy themselves, then you might get that up. And if we do a really good job, we could potentially be looking at 30% of students on campus per day. I want to put that in a perspective for you as well. About 20% of the students, or let's just say 200 students, 250 students live in the dorms. And so for them, this is potentially a viable option almost every day for at least one meal. At the same time, the students that are on campus, a large percentage of those, probably 80% of the students that are on campus in any one day, eat at least one meal on campus a day. And so what we're really doing there is we might be supplanting some of the consumption that is already taking place at other places. And then similarly, there are a certain number of students that maybe eat on the way to school or when they leave school that we don't have in the numbers right now, who we would hope would just simply choose to do this instead. And so in a best case scenario, we could actually get up to about $3.5 million in equity value and $6 million in PV over the 10 years. Now, worst case, obviously, we could have problems with our food and labor costs that cause those to go up. Customer spend could be low. I don't see it going below $8, just like I don't see those going above 30. I mean, at that point, you've lost complete control. And then number of students, maybe only 10%, which would be exceptionally low. It sort of suggests that we've missed our mark in terms of the need or satisfying that need. But even at that, we wind up with an equity valuation of about $500,000 in PV of over $900,000. And so, kind of encouraging the fact that we don't need that much money invested, number one, and that even in what we would envision to be our worst case scenario, we believe that we're still going to be profitable. It's not one of those situations where in the worst case scenario we walk away with no equity left. From an NPV standpoint, again, same information, nothing's really changed up top, just kind of graphically you can see NPVs really almost $1 million up to $6 million. And so, the skew on these things, obviously for both of them, without making really big assumptions in terms of best case, really the tail stretches way to the right. And so we would say there's a lot of upside here. There's a little bit of downside, clearly, but even that downside doesn't go negative. So that's kind of our assessment of the risk. In terms of financing assumptions that are built into this, we're assuming 80% of the plant property and equipment is debt financed. That would include building the building, and equipment, so land building equipment. And we estimate we're going to need just under $250,000 a year for that. We would anticipate that we're going to take that out in a long-term, sort of a 10-year loan with amortized annual payments. And then in addition to that, we're going to need to finance about 50% of the working capital with debt. And we would do that as short-term debt with a single balloon payment at the end of the year. So very short-term, which ought to also help with the interest rate on that. And so we're going to need about $31,000 there. In terms of equity financing, we would want to raise equity for the remainder of what isn't covered by the long-term financing on the PP&E and the remainder of the working capital. And so we really need about $9,300 in equity financing. And that's just sort of what's built into the model. Now, in terms of the opening ask, I guess, from our standpoint, we would like to achieve an 8% rate on the debt, both long-term and short-term. The long-term, we think that's reasonable because that would be secured debt. It's basically commercial debt, but it's secured by the land and the equipment and the building. And the short-term, while it's not secured debt, it is very short-term, and so I think for 1 year, 8% is a reasonable ask. Again, if we needed to sign some sort of personal guarantee on that, we certainly could. And then in terms of the equity financing, we're thinking in terms of probably $100,000, so that kind of is a little bit more than the 92, but gives us a little bit more cushion. In return for that, we would offer up a 8% equity interest, and so based on the likely case, that would be the equivalent of about a 16.1% internal rate of return to the equity investor over the life of the project. And 16% on something that has, quite frankly, no real opportunity for a loss and substantial opportunity for gain. Seems like a very fair return to us, and so that's kind of how we're thinking about it. Happy to keep talking and negotiating. So anyway, that's kind of what we're going for. Now, probably there's a question about where you get some of these numbers. All of the numbers in terms of what you're financing, your capital contributions from equity, you're getting all of those from the financials, okay? The one that a lot of people look at and they're like, well, I do not really get the how'd you come up with how much equity you're going to need and all of that good stuff. Here's kind of what I've done, and we'll put this spreadsheet out there for you. I've created a cost of equity sheet, all right? And that cost of equity sheet does all of the same sort of internal rate of return stuff that we did to calculate equity in the first place, except for now I've added something here that allows you to say, okay, well, let's say that this was the value of equity, right? In which that's just determined by whatever your implied cost of equity is. And you've added to that what percentage of the product, of the overall project is going to go to the equity holder. And so you take this number times the percentage, and that's sort of their implied value. That's what they would be getting as an investor. And then what you want to do is to basically say, what will they be giving me as an investor? And you want to basically calculate a cost of equity that makes these two values equal, right? And so again, we'll cover that more in class, in really the theoretical discussions. But the idea here is that simply you're saying, okay, well, let's say that I wanted to give them a 7% share. I would change this to 7%, and I'll go ahead and highlight that as a change for you. And maybe we'll highlight that so you know that's the output, right? And so you can see at 7%, the implied value to equity is less than the money received, and so you've got to go solve this to get them equal. So we're going to do the data what-if analysis. Where'd that go? There it is. Goal seek. So we're going to set this cell 13 to 0 by changing the implied cost to equity. Okay. Yep. Hit the wrong thing. My bad. All right, so let's do it again. What if goal seek, we're going to set that to 0 by changing this cell. There we go. Okay. So it solves, and it basically says, oh, to get that to 0 at a 7% share of the project, having a 7% share of the project be equal to $100,000 you want from them is returning a 14.5% as an example, internal rate of return or implied cost of equity. And so that's sort of a simple way for you to go back and forth. Now, you'll want to be able to do this whenever I negotiate with you so that you can understand what you wind up with as your final cost of equity. Anyway, I hope that's useful for you guys, and can't wait to see how the negotiations go.